Let's get to one of our big movers of the day, and that is Disney. Shares extending gains after beating on first quarter results and boosting their forward guidance. Now, the company also announcing a new partnership with Epic Games. You're looking at a move, look at that, at just about 8% ahead of the open. Now, it did impress the street, but Nelson Peltz, activist investor, he's still not buying it. Spokesperson for his Triumph Fund is saying that, quote, it's deja vu all over again. We saw this movie last year, and we didn't like the ending. For more on this, we want to bring in Brandon Nespel. He is a KeyBank Capital Markets research analyst. We also have Yi Tai, Santa Clara University Associate Professor of Finance. Great to have both of you here. Let's talk about what we heard last night, Brandon, because there was certainly a lot to be encouraged about. When you take a look at the streaming business, clearly in a much better spot, to put it lightly, than where we were a year ago. The parks business was also one of the standouts here. A lot of things to be excited about in terms of the restructuring or redirection of Disney's business. Is it enough, though, to prove that outside influence or an outside factor maybe isn't needed at Disney?
Well, I don't think there needs to be outside influence. I think Bob Iger seems to have everything under control. And the main areas of improvement were really around cutting content expense. You know, our concern is for a content company, it's difficult for us to see that content expense can trend lower for forever. And so it's sort of a near-term benefit, if you will, sort of right-sizing the amount of content the company is spending, which has really helped improve profitability across the segments.
You would love to know from your perspective here, as we're thinking about all of what Disney had to say last night and whether or not this quells some of the question marks that many of the activist campaigns had to this point. What is your anticipation of what the rebuttal will be and the campaign will continue to sound like?
Yes, so the activist, the Nelson Peltz, his campaign, one of the attacking point is about Disney's corporate governance. And if we look at the book, all the directors except the CEO, Bob Iger, everyone else look very independent in the sense that they do not have a material relationship with the company. And in fact, all the independent directors adding together, they own less than 15%, less than $15 million in terms of the holding in the company. However, if we look closer, only 2 of those independent directors were appointed not during the CEO tenure. Basically, either some of them are appointed during the first tenure of Bob Iger as CEO or during his second tenure. So inevitably, Bob can have a strong impact on the board. And research called those independent boards on the book, but appointed by CEOs as co-opted boards. And we have found that on average, those co-opted boards tend to weaken the board monitoring and tend to grant higher CEO compensation. And they're less likely to fire the CEO if the company is not doing well. So, and these are the main attacking points of the Nelson's campaign. And as we can see, definitely there are issues potentially with the corporate governance remaining on the Disney's board. Having said that, doesn't mean friendly board can always be a negative thing. If the CEO is really capable of pushing things forward, then those friendly boards can really be providing helping hands there to move CEOs' progress and help improve the firm performance.
Brandon, there's lots of questions, or one of the big pushes here from Peltz. Obviously, he wants Disney to lower and really obviously turn around the streaming part of the business and turn it around, meaning wants it to be obviously profitable and then the growth potential from there. When it comes to what we heard last night over the last 48 hours with the plans here for the new sports app, how much does that then change the conversation, and how much of an impact or how big of an impact do you see this potentially being on Disney's bottom line going forward?
Well, I think in regards to the direct-to-consumer business, the non-sports business in particular, Peltz got probably everything he wanted. Disney, for the first time ever, talked about getting to a double-digit sustainable margin. I think the question will be, how long will it take Disney to get there?
Brandon, what do you think that timeline looks like?
From our perspective, it's more of a 2027 type of timeline, so still a couple of years out. But that's exactly what the Bulls wanted to hear, is some sort of commentary around long-term margin trajectory of the business. It's something to anchor the models around once Disney gets to break even later this year.
We do know that Nelson Peltz and his constituents, the people that he's representing, they want to see Disney achieve Netflix-like margins. Do you believe they could do that in kind of congruence with what Brandon was just saying?
So yeah, I have a similar sentiment. It's not an easy battle in the short term. And Disney have shown really nice earnings this past quarter. And they have also do all other kinds of things to really please the investor. For example, they just announced to increase their dividend from 30 cents to 45 cents. So that's their planned dividend payout. However, do keep in mind that before the pandemic, their dividend was 88 cents per share right before the pandemic. So they had to cut the dividend to sustain their cash flow stream. And I'm glad to see that Disney is reinitiating dividend. And that is usually a welcoming sign to the market. But I think being able to really growing their streaming business to a pace that like Netflix, it might take some time.
Brandon Nisbell, KeyBank Capital Markets Research Analyst, as well as Yitai Santa Clara University Associate Professor of Finance. Thank you so much for taking the time here today to discuss all things ticker symbol DIS this morning. Appreciate it.